Imagine receiving a paycheck from your investments every single month, just like you do from your job. This is the world of monthly dividend stocks. Most stocks pay you every 3 months, creating lumpy income. But monthly payers align perfectly with your recurring bills, mortgage, utilities, and groceries. But what exactly are these stocks, and how can they afford to pay out cash 12 times a year when most companies struggle to do it 4 times? In this deep dive, we'll explain the mechanics behind these payouts, the specialized business structures involved, and the pitfalls you must avoid. As of mid-2026, the average dividend yield in the broad market is quite low, making high-yielding monthly payers extremely attractive to income seekers. The first major category is real estate investment trusts, or REITs. These companies own and manage income-producing real estate. By law, REITs must distribute at least 90% of their taxable income to shareholders to maintain their tax-advantaged status. Next are business development companies, or BDCs. Think of these as public versions of private equity firms that lend to small businesses. Just like REITs, BDCs are required to pass most of their profits directly to you, the investor, often on a monthly schedule. Then there are closed-end funds and ETFs that use active strategies, like covered calls, to generate high monthly distributions from standard stocks. Finally, we have mortgage REITs, or REITs. These don't own buildings, they own the debt on buildings, offering some of the highest yields available. But be careful, REITs are highly sensitive to interest rates and can be much more volatile than traditional property-owning REITs. One of the biggest advantages of monthly dividends is faster compounding. Every month, you get cash to buy more shares. Using a dividend reinvestment plan, or DRIP, those new shares immediately start earning their own dividends, accelerating your wealth building. Reinvesting 12 times a year instead of 4 also allows for better dollar-cost averaging, smoothing out the price you pay for shares. Psychologically, seeing money hit your account every 30 days provides a powerful sense of progress and keeps you disciplined during market dips. It turns your portfolio into a true income replacement tool, matching the rhythm of your actual life and financial obligations. However, not all monthly dividends are safe. This brings us to the most dangerous part of income investing, the yield trap. A yield that looks too good to be true, say 15 or 20%, is often a warning sign that the company is in trouble. The key metric is the payout ratio. If a company is paying out more than 100% of its earnings, the dividend is unsustainable. Ideally, you want to see a payout ratio well below 100%, leaving room for the company to grow and protect the dividend. You also need to watch interest rates. When rates rise, many monthly payers see their borrowing costs spike, which can hurt their stock price. Another risk is sector concentration. If you only buy monthly stocks, you might be too heavily weighted in real estate and finance. A balanced portfolio should still include growth sectors like technology and healthcare, even if they only pay dividends quarterly. Don't forget the tax man. Dividends from REITs and BDCs are often taxed as ordinary income, not at the lower qualified dividend rate. Because of this, many investors choose to hold these monthly payers in tax-advantaged accounts like an IRA or a Roth IRA. Let's look at a legendary example, Realty Income. They literally trademarked the phrase, the monthly dividend company. They have paid over 600 consecutive monthly dividends and have increased their payout for over 25 straight years. Another popular choice is Main Street Capital, a BDC that focuses on lending to middle-market companies with consistent cash flow. They have a track record of not only paying monthly but also providing bonus dividends when the portfolio performs exceptionally well. If you prefer not to pick individual stocks, look at ETFs like JEPI, which uses a covered call strategy to pay out monthly income. These funds give you exposure to hundreds of companies while still delivering that monthly paycheck you're looking for. So, how do you build a monthly dividend portfolio from scratch? It starts with setting clear income goals. Determine how much monthly cash flow you actually need to cover your target expenses and work backward from there. Don't put everything into one sector. Mix high-yield BDCs with more stable retail REITs and broad market income ETFs. Always perform your own due diligence. Check the company's debt levels, their history of dividend growth, and their management team. Decide if you need the income now or if you're in the growth phase. Reinvesting is the key to massive long-term wealth. Dividend investing is a marathon, not a sprint. The real magic happens after years of consistent monthly contributions. Review your holdings at least once a quarter. Make sure the why behind your investment hasn't changed. Keep in mind that companies can change. Stag Industrial, for instance, recently moved from a monthly to a quarterly payout schedule. You must be flexible. If a stock you love stops paying monthly, evaluate if it still fits your overall investment thesis. Ignore the short-term noise and the get-rich-quick schemes. Monthly dividends are about steady, predictable growth. Always focus on total return, which includes share price appreciation, not just the dividend yield. A high yield doesn't help if the stock price is crashing. Consider how these stocks fit with your other fixed income investments, like bonds or high-yield savings accounts. Monthly dividends can act as a natural hedge against inflation, especially if the companies have the power to raise their own prices or rents. While most famous monthly payers are in the US, there are opportunities globally for investors willing to look abroad. To recap, monthly dividends offer better cash flow alignment, faster compounding, and psychological peace of mind. But they require careful monitoring of payout ratios, interest rates, and tax implications. The best investment you can make is in your own education. Keep learning about the companies you own. With the right strategy, monthly dividend stocks can be the engine that drives your journey to true financial independence. Let's go deeper into equity REITs. These companies often have long-term leases that provide very stable cash flow. Retail REITs that house essential businesses like pharmacies and supermarkets are often the most resilient monthly payers. Industrial REITs focused on e-commerce warehouses have seen massive growth lately, though their yields tend to be lower. Back to BDCs. Remember that they lend to smaller companies that might be more vulnerable during an economic downturn. The quality of a BDC's management team is everything. You want managers with a history of avoiding bad loans. Closed-end funds often use leverage, borrowed money, to boost their payouts. This increases both your income and your risk. Watch out for a return of capital. Sometimes a fund isn't earning its dividend, it's just giving you your own money back. The popularity of monthly paying ETFs is at an all-time high, with new options launching every month for different sectors. Some smaller niche companies also pay monthly, but these often carry much higher volatility and lower liquidity. Financial freedom isn't about getting lucky, it's about building a system that works while you sleep. Monthly dividends are that system. The snowball effect is most visible when you see your monthly dividend grow from a few dollars to a few hundred, then a few thousand. Discipline is the bridge between goals and accomplishment. Don't let market headlines distract you from your monthly routine. For retirees, monthly stocks provide a sense of security that quarterly payers simply cannot match. It's like having a pension you control. Many investors aren't even aware that monthly dividend stocks exist. Sharing this knowledge is the first step to building a community. Look beyond the yield, read the annual reports, understand how the company actually makes the money it's sending to you. Every market cycle is different. Some years favor REITs, while others favor BDCs or income-oriented ETFs. Diversification protects you. High debt levels are the enemy of sustainable dividends. Only invest in companies with manageable debt-to-equity ratios. Healthcare REITs are an interesting niche, benefiting from the aging population and long-term essential service needs. Data center REITs are the backbone of the internet, though many have transitioned away from high yields to focus on growth. Yield is important, but yield growth is even better. A company that raises its dividend every year is a true wealth creator. Is your portfolio ready for a recession? Stress test your monthly payers to see if they could survive a temporary economic dip. Building a monthly dividend portfolio is about more than just you. It's about creating a legacy of financial security for the future. You now have the foundation to explore the world of monthly dividends. Start small, stay consistent, and watch your income grow. Thank you for joining us on this deep dive. Your journey to a monthly paycheck from the market starts today. Happy investing.